The Nasdaq and the S&P 500 hit fresh record highs once again this week, while the dollar retreated from a 9.5-month high. Now, I'm pleased to say we've got a guest with us today who's here to share his outlook on a number of different markets, and he has a rather contrarian view. I'm pleased to say that I'm joined by David Hunter, contrarian macro strategist. David, great to chat to you. Let's first talk about how it is that you analyze the markets, because you go about building your contrarian view. I'm wondering whether it's a case of just listening to what the Wall Street analysts are saying and going the other way, or if it's a bit more nuanced than that. Talk us through the way you see the markets.
Sure. I generally, my macro work is mostly what comes first. The contrarian part of it helps to reinforce it, but I start first with my macro overview, and it's not unusual for me to have a contrarian view, but it's not like I want to be, I start with the premise that I'm going to be opposite the market. Sometimes I'm very consensus. As I say, at the turning points, it's not unusual for me to be very lonely in my position. Normally, at major turning points, I'm a very lonely voice, and that comes naturally to me. But it's really the macro work that comes first, top-down type analysis, looking at fundamentals and technicals, cross markets, etc. And then sentiment's certainly a big part of it. And when sentiment's very much in a large majority, I'm pretty comfortable going the other way. But I'm not a what I call a knee-jerk contrarian, where the street's here, I'm here. It's more the macro drives my work, and then if it's contrary, it's all the better.
Let's get your view on the growth outlook now, because after a surprisingly strong rebound from the depths of COVID last year, we've seen most of the major economies and leading emerging markets as well peak in terms of GDP growth. So how optimistic are you about the global recovery moving forward?
Yeah, I think we're in the late stages of a recovery, but the street oftentimes reacts to pauses and takes it a little bit too far. So I think we definitely had a slowdown in the economic momentum over the summer, a pause of some sort. I'm not sure that pause just keeps deteriorating. I think we're going to see a pickup in the economy, particularly on the production end because of the low inventories. So I think as we move towards the end of the year, you're going to see better GDP, better economic growth. And I think what the street's done is just extrapolated the summer and said, okay, we're slowing down. So I'm not so sure that's going to be the case, but I do think we're late in this cycle. The cycle started in 2009, and I think we're probably going to come to the end of it late this year, early next. So either late this year or sometime in the first quarter, and then I think things get pretty negative after that.
So you're basically saying that we're coming towards the end of the growth cycle. How does that translate into what we see for the market cycle?
The market cycle probably will lead, as it usually does. So I think we could see a top in the market sometime this fall. It may stretch. I've seen it. I've been guilty of being early on this, but I think it's sometime between now and the end of the year, I think we're going to see a market top. That market top, I think, could be quite a ways from here, because I think we're in a final melt-up stage, a parabolic stage. You're seeing the market kind of defy everybody's expectations here in the last several days and just keep pushing higher, and everybody keeps trying to call, a correction. I think that's because we're in that late stage period where it could really start taking off. So distance-wise, I don't think we're very far away from the top in the market, and I view this as a secular top, that secular top to a bull market that started in August of 1982. So it's a top of a 39-year bull market, and the economy, the market tends to lead. So I think that top coincides with within a few months after that with a a top in the economic cycle. So, and then I think what comes thereafter is pretty negative. Both a bear market that could be peak to trough 70 or 80% downside, and an economy that I am calling a global bust. And I use the term bust to differentiate from a recession or a depression. It's kind of in between the two. More the speed of recession, but some of the damage of a depression. So I think 2022 could be a very negative period for both the market and the economy.
So that bear market that you're predicting with 70 to 80% downside, you're saying that's likely to start this autumn. And is that going to be a short, sharp move lower or a prolonged period of declines?
Yeah, first of all, the top, we could see a top as early as October in the stock market. It might, take longer than that, but we could see the top then. But tops don't typically go, you don't tick at the top and then go straight down. So, the top may take a month or two before we see any big downside, or you could see a sell-off and then a retest of that top at somewhat lower than the original high. So I'm kind of saying the high is probably this fall. Whether we start straight down from there, I think is a big question. I don't necessarily think we can know that yet. So whether the top is very, very quick or whether it takes a couple months to build, we'll see. In terms of the downside, what I will say is I think it'll be faster than 2008-9. So and particularly the biggest part of 2008-9, which was the October 2008 or September, October 2008 to March 2009. I think the bulk of this will happen even faster than that. Whether peak to trough, it stretches out beyond that. It could, we could be at a bottom as early as next summer, or it might take most of the year before it bottoms out. But either way, if it's anything close to an 80% decline, that'll be pretty fast to get there in, say, 6 to 9 months.
Last week's Jackson Hole Symposium saw Fed Chair Jay Powell reiterate that the decision around tapering would be separate from the decision around when rates will eventually move higher. Does your thinking around the declines that you see on the horizon for markets tie in with what we're likely to see from the Fed?
Yes and no. I was not surprised by Jay Powell's comments. The week preceding that, we had several of the regional Fed governors coming out and talking about taper as early as September. And not surprisingly, I think Powell pushed it back and said, at the earliest, probably late this year. So I think that's a lesson to people. The hawks the hawks in the Federal Reserve, I think, like to hear themselves talk, and yet their track record is not great in terms of trying to front run him. So I think you got to listen to the chairman, and he's been pretty transparent about letting inflation run hot and not jumping the gun too soon. So I think we can pretty much assume that we're not going to see taper much before December, if then. And I do think we could see it by then because of a stock market that's overheating and inflation that I think is going to be higher than it is now. In terms of interest rates, I actually come out saying we're going to see rate increases in the bond, mostly pushed by the bond market, not so much Fed fund increases, but rate increases from between here and the end of the year. I'm calling for a 2.5% 10-year, for example, that we could be there, late this year, early next. But it's not because of Fed pushing it there, tightening. In other words, it's really because of so-called bond vigilantes. The bond market really sets rates when you get into these periods, not the Fed. So I think they will have to raise Fed fund rates before they are talking about. I think we'll see rate hikes in 2022, perhaps early 2022. But I don't think it's going to be a long rate cycle. I think mostly they're going to be doing their tightening in terms of pulling money out of the system. So QT. I think everybody wants to focus on Fed fund rates or Fed policy in terms of rates. I think you really should be looking much more at what are they doing with quantitative easing or tightening.
As I mentioned in my introduction, the dollar has been pulling back this week, hitting 1-month lows after recently scaling more than 9-month highs. Where do you see the greenback going from here?
Sure. Yeah, I'm probably the bear on the street in terms of the dollar. I've been calling for the dollar down to 85. I started talking about 85 on the dollar way back when it was near 104, a year and a half ago. And I've been consistently saying we'll get there. You get these counter trend moves like we've had for much of this year, and you get everybody looking the other way and saying we're going up. And I consistently said, no, this thing will reverse downward again. My expectation is 85 at a minimum, and I actually think the more likely target for the dollar is 80 on the index. So I'm definitely a bear on the dollar near term. In the bust, next year's bust, I think the dollar will be get the flight safety trade from across the globe, and you will see, I think, the dollar at 120 to 140 next year.
And in terms of commodities, although Brent crude is off the highs, it is still above $70 a barrel. And OPEC Plus has said that it's planning to stick with its policy of increasing oil production. That's despite some concerns about demand. Talk to us about your forecast for what's going to be driving prices forward.
Sure. I was a big bull on oil coming out of the March 2020 swoon. And when oil was $10, I was saying we could see it upwards of 45, 50. And then I raised that ultimately up to 65 and then ultimately to 75 or mid 70s. I think that's the high water mark for oil. I don't think we're going to see major new highs in oil this year. And I think ultimately the bust next year will take oil back at least into the 20s, and we'll see whether it goes below that. But I think you can get it back down probably into the mid to high 20s. So I think you're, from looking out more than the next couple weeks or the next month, I think you're looking at a risk reward that says very limited upside and an awful lot of downside. So from a longer term standpoint, there will be a recovery, what I call an industrial driven, inflation driven recovery following the 2022 bust. So 2023 to 2030, I think, is going to be very much like the late 70s and early 80s, or like the 70s and early 80s. And so you could see inflation all the way back to where we were in the early 80s, retrace 40 years of disinflation and get back to, say, 20% inflation rates. In that environment, later in the 2020 decade, you could see oil north of $300, maybe even north of $400 a barrel. So I think we have one big sell-off in the bust, and then I think oil becomes one of the leading areas again.
Judging by your answers in this interview, you're clearly not afraid to make big calls. Oil down to $20 a barrel, potential 80% correction for equities. I'm wondering how accurate your calls have been in the past.
Sure, pretty successful. I've obviously had my moments where I've been off too. I started talking about global deflationary bust back in the early teens, 2013, 14. Not that it was necessarily imminent, but that the seeds were being sown and that it was coming. I switched to the bull side again. I was back and forth through 2014 to 2017, in terms of making calls where you get rallies and things. But I really switched to this late stage bull market story in the latter part of 2017, and I've stuck with it since, saying that the end of this cycle will end in a parabolic melt up. And I was talking about north of 4,000 in 2019. I had a target of 4,200, I think, coming in, and March of 2020 hit. I stuck to my target and said, this I could easily call this the beginning of the bear, that we didn't get as high as I thought. But I re-looked at my work and said, no, sentiment's so negative. This is a fake out. And you will, the bull market will continue, and we will see that melt up. So I had a $4,200 target on the S&P in March of 2020. And along the way in the last year, I've raised it from there to first 4,500, then 46 and 700, and most recently in early July, raised it to 5,000. And I have to honestly say, the odds are I'm going to be raising it up, whether it's 5,300 or 5,500. I think I've been saying for a while, my 5,000 probably conservative. So it's not good until reached. I've raised my targets well in advance of where the previous number was, but it just, this thing has legs. And same thing, NASDAQ, I have an 18,000 target on the NASDAQ. I wouldn't be surprised to see that get above there. So certainly in the last year and a half since the pandemic started, I don't think there's anybody on the street that compares to my call. I mean, most people back in March of 2020 and second quarter of 2020 were looking for the market to continue lower, and they thought I was insane to say not only is it going up, that it's going to go up in a major way where we more than double the market.
So if and when we do see this big correction in equities and in oil, is that when you're going to be bargain hunting in the markets?
Yeah, for sure. I think I'll answer it this way, because I don't talk trading my own or others, but I'll answer it this way. I do think in the cycle, and there will be a cycle following this big bear market. By the way, I don't think we'll see the highs that get reached at the top of this secular bull market, and I think it's this year, are probably not going to be revisited for decades, and that's plural decades. So I think what comes in the years after the bust, we can have a very good cyclical bull market, but it won't be a secular bull market. In other words, we'll see lower highs and ultimately lower lows. So, but I do think the recovery cycle that follows the bust will be led by commodities. So oil will be a very big part of that. Gold and silver will be a big part of that. Copper, et cetera. I think pretty much across the board, including ag commodities, will, I think, see major new highs. So while the stock market won't be seeing new highs, you'll see commodities making major new highs in the 2023 to 2029, 30 type period. So in response to that, yeah, I would say there's going to be a lot of bargains in the oil area, sometime next year.
David, it's been great chatting to you. Thank you so much for sharing your analysis. Some very interesting calls there.
Oh, thanks, Victoria. Thanks for having me on.
And that was David Hunter, Contrarian Macro Strategist. I'm Victoria Scholar, and thank you so much for watching IGTV. You can find more from me on Twitter. I'm at VictoriaS_IG.
For more videos like these, you can follow us on Twitter, Instagram, and subscribe to our YouTube channel.